I'm Scott Starratt with Starratt Wealth Management, a part of Canaccord Genuity Wealth Management. So March was a very, very strange month, one of the more volatile months, even though the market indices didn't necessarily indicate that. One of the things people have been talking about over the last little bit is why the market keeps on going up when obviously we're still in, I guess now in a third wave of a global pandemic. And I think there's three real reasons for this. Reason number one is obviously the optimism around vaccines. Although there are some countries that are doing much better than others, like the United States, Israel, and the United Kingdom, there are other countries like Europe, or regions like Europe and like Canada, that are falling behind. Although the expectation is that these more Western countries will definitely catch up at some point in the near future. The other optimistic feature is the fact that there's a huge amount of what they refer to as fiscal support, meaning a huge amount of money being spent on the pandemic response. In the United States, they just passed a $1.9 trillion bill. You're in Canada, we're spending a lot of money. Basically everywhere in the world is spending a lot of money and throwing it at this issue. The third issue, or the third reason, I guess, is predominantly the low interest rates and the fact that central banks throughout the world, whether it's the Fed in the United States, the ECB in Europe, the Bank of Canada here locally, are all keeping their interest rates quite low. I'll come back to interest rates in a minute, but those three reasons are the primary reasons why we've seen markets continue to have strength over the last little bit. Now, like I said, March was a very strange month, and really it comes down to this idea that there are two different types of stocks, and analysts and consultants who consult for institutional mandates, institutional boards and foundations and pension funds like to bucket them into two different categories, stocks into two different categories, either on one hand growth and on the other hand value. And really for the last 10 years, growth has outperformed value. Now, normally growth we see as being a tech company like Amazon or Facebook, but it can really be any company that is in a high growth phase of their business. So obviously, like I said, the Amazons, the Apple, Zoom, all these stay-at-home companies and tech companies that have done really well over the last little bit have continued to lead the market out of the bottom, which was March 23rd of last year, and has kind of pushed things forward. The value stocks, on the other hand, which people would a lot of times consider energy companies, banks, financials, cyclical companies like materials, these companies that do well when the market is, or when the economy is booming, they've really underperformed the growth stocks. Yet in March, what you saw is a complete switch of that. So like I said, for 10 years, or essentially 10 years, we've seen growth stocks do significantly better than value. We started to see in March, or not just started, we've seen an aggressive move in March towards value outperforming growth. And give you an example. So last year in 2020, the top, if we look at the top 20 stocks on the S&P 500 versus the bottom 20 stocks on the S&P 500. So far in 2021, those top 25 stocks last year are down 3%. The bottom 25 stocks last year are up over 30%. So you only have to look at this to see the fact that these value stocks, they could be airlines, they could be lodging, it could be, like I said, energy. These stocks have really made a strong move upwards. And that has really caused a lot of issues in the economy. If you were, for example, really betting heavy on growth stocks, you had a really tough time in March, and you probably significantly underperformed the index. On the other hand, if your focus is more on value stocks, you probably did quite well, or at least held your own in the month of March. One really good example is there was a firm, a family office out of the U.S. Where they basically, and it's uncertain now how much leverage or how much debt they had in the fund, or in their portfolio, I should say. And basically they had to sell significant numbers of their positions in order to meet a margin call. And you would think, well, the market was doing okay. Why would there be a margin call? Well, because they had levered up or borrowed against Amazon, Zoom, companies like that, that again, in March had a really, really tough month. So that's probably going to continue. That volatility is going to continue. And what it really does is it shows that a manager who's able to, pick these companies that are, maybe the reopening companies, the companies that are going to do well when the stock market, when the economy continues to reopen, they're probably going to do a lot better than maybe growth companies. But then again, I could be coming to you next month and saying the reverse is true. That's the thing. There's so much uncertainty right now, and we expect this uncertainty to continue throughout the year. One of the other risks or fears out there is inflation. And, we've heard this over and over again, how expensive things are getting. There was a news article last night I was listening to that basically talked about the idea that, in the US, they're expecting in the neighborhood of a 3% inflation rate for food next year. I was talking to a client, yesterday, who said that, they're looking at OSB board that they used to pay about $15 a sheet for, now selling for close to $60. So, you and I who go to the grocery store or have our groceries delivered, or go to a Home Depot type of store, really see that the value or the prices have gone up significantly. Yet inflation just doesn't seem to make a move yet. Yet that's the biggest concern right now, is the fact that what if inflation does come back? And that concern is developed or is kind of leaked into the market. So this time last year, we were sitting at about a 10-year US bond rate of about 0.65%. So very, very low. So if you locked in your money for 10 years in a US government bond, you'd get a whopping 0.65% a year. That's gone up to about 1.65% in the last 12 months. And as of today, it's about 1.65%. So that's a huge increase. I mean, 1.65, we all know, is still very, very low. But that's a huge increase, going from 0.65 to 1.65. And what it meant is, because bond markets tend to act opposite of interest rates, meaning as interest rates go up, the value of the bonds were to drop, and vice versa. You saw in the first quarter of 2021 here, the largest drop in fixed income in bonds, government debt, in 50 years. It was down over 5%, the Canadian bond market. That's quite a significant drop when you consider that a lot of people in their portfolios have the bonds in there in order to act as the stable part of the portfolio. But that's also meant that because the bond prices are going down, and because cash continues to pay essentially nothing, more and more people are putting their money into stocks. Globally, as of a few days ago, Bloomberg reported that about 70% of people's assets are now in stocks. That's down from a record high in 2007. Notice the similarity, but in 2007, where stocks were about 75% of client portfolios. Very, very high. We continue to believe, and the performance shows, that you don't necessarily have to be invested in aggressive stocks or have a whole bunch of money in unprotected equities in order to do well in the markets. As we've been doing your reviews, you see the returns are quite strong, even though we've continued to be underexposed to traditional stocks, as it were. The last thing I wanted to point out was that we're looking at inflation again. Going back to inflation, we're looking at the next few months being quite volatile for inflation. The reason why is because they're looking at a year ago. So if you say, okay, well, what is, say, for example, the price at the pump now? In Canada, the average is $1.25. A year ago, that average was somewhere in the neighborhood of 90 cents. So, that's a huge increase, and obviously it's inflationary. But so in the next couple of months, you will see these inflation numbers tick up, although most people do expect them to be short-lived and that we get back to a more normal inflation. That being said, the Bank of Canada, the Federal Reserve, all the central banks continue to say that they are going to overshoot on the inflation target, meaning if they expect inflation to be, or want inflation to be an average 2% over the long term, and because inflation was significantly less than 2%, that they are quite comfortable going to 2.5% to 3% over the short term in order to get that average back to 2. That's great if they're able to actually stop the inflation from becoming an issue. But as we know about big container ships, governments and economies are no different. If you're trying to traverse the Suez Canal of interest rates, and you're a big ship, it doesn't take much for you to get pulled off course a little bit and for bad stuff to happen. So that's probably one of the biggest things we're looking at, is what's going on with inflation, how that's going to affect the markets, and at what point are governments throughout the world going to have to stop their money printing in order to deal with the inflation concern that might come into play. As far as individual portfolios this month, it was another positive month. We also continue to have our best performers performing quite well. We continue to believe that a lot of the managers that we have are still doing what they're being paid to do. No one is of a concern to us. We have no one on watch. We're quite happy with all the managers and how they've performed. Tax time, of course, tax deadline is April 30th for filing. What we're going to do is, or what we have done, is we've sent out checklists or packages and tax slips to everyone now. You should have everything except for one tax slip, which is now in the mail, but we just haven't got our copies yet. So if you do, before you do file your taxes or give it to the accountant, just touch base with us if you have any questions. It was a little bit confusing this year because, you had tax slips from Richardson, tax slip from Canaccord, and tax slips from both. So it was a little confusing. So don't hesitate to reach out to Hengi or Angela, or of course Jim and myself, to chat about what you're missing or what you still need to receive for the income tax. That's about it for now. Obviously, Jim and I are available at any time. No vacations coming up anytime soon. We're around any time to answer questions or chat. And we're also, as I say every month, more than happy to sit down with friends, family, or colleagues that may not have had a positive experience over the last year or so with their advisor or with their investments. We've been getting a lot of incoming calls about that. There seems to be this real mix of people that some have done very well, but there's a lot that haven't. And so we're spending a lot of time talking to your friends and family about that over the last month or two.